Our first speaker is Gregory May. Greg joined the Tompkins Trust Company as Vice President of Residential Mortgages in 2008. May has over 40 years experience in the mortgage field. Before joining Tompkins Trust Company, he was Senior Vice President, Residential Mortgages for NBT Bank in Norwich, and before that was Senior Vice President at OCNB Bank in Oswego, New York, in charge of all retail branches and lending. In his position with Tompkins Trust Company, a leading mortgage lender in Tompkins County, May oversees a staff of mortgage specialists and is responsible for secondary marketing, product, program design, and business development. May is past president of the Central New York Mortgage Bankers Association, has served on the boards of the Mortgage Bankers of Western New York and the MBA of Northeastern New York. He is here to speak to us this evening on the topic, Gas and Oil Leases Impact on Residential Mortgage Lending. Thank you.
Thank you. These poor fellas that try to film, I wander, and I have to try to get myself, first of all, to use the microphone, which I don't like to use, and then to stand in one place. So I'll have to walk over there to change my screen every once in a while, but I promise that I won't go far. No, we don't have a clicker. The first thing I'd like to do is say thank you for inviting me. And as the screen says, my reason for being here is not to take a position either pro or con gas drilling, fracking, any of those things. My reason for being here is to try to help educate. I talk specifically about residential mortgage lending. That's 1 to 4 family, where you and I and our neighbors live. It's not commercial property. It's not commercial financing. It is, in fact, residential in nature. I've handed out, or someone's handed out, a copy of this PowerPoint presentation that gives you a chance to jot some notes. It'll also be some reference material that you'll be able to take with you. So with that said, once we have that set, is that I am not taking a position either for or against. And my position at the trust company, they would not want me to take a position for or against, but I try to present factual data so that you can make your own educated decisions. Fair? Great. I usually start out with a little presentation just to try to drive home maybe one of the points that I'm going to be making. Here is a very nice pen, and I sometimes get here early enough and set it up with somebody in the audience where I'll slip them $1 and say, you and I are going to have a buy-sell exchange here. I'm going to sell you this pen. And I go on to show that it writes very nicely, and I draw on something and whatever, and then say, would you like to buy this pen? And the person in the audience would say, well, yeah. And I say, okay, fine, we've agreed on $1, right? Right. And then I unscrew the pen, and I take the ink refill out, and I set it off to the side, and then I go to that person, okay, here's your pen, could I have my $1? Now, does that person feel that they got a fair exchange? We agreed that we were buying everything. I showed how it wrote, yet when I took that ink refill out, it changed something. It arguably changed the value of the pen, and that's really the point that I'm trying to make. Very similar to when you're leasing the rights to minerals below your house. And the first thing we're going to talk about is several of the issues that go around with valuing residential property. And those pieces fall into a range of what's called fee simple ownership. Fee simple ownership means that you are buying a wedge of property that goes from the center of the earth. I like to throw my hands around too. This is tough with a microphone. From the center of the earth to the heavens above. And that's really what you're buying when you buy fee simple, and you're buying everything in between. So you're not just buying that residential home that's on the surface, but you're buying fee simple ownership of everything from the center of the earth, a core of property, from the center of the earth to the heavens above. Rocks, dirt, stone, water, whatever is there. Real estate in New York State is transferred, for the most part, in a fee simple ownership basis. So when you buy real estate, you are buying fee simple. When you sell, you're giving all those rights away with a property. That's the first problem we have with gas leases, that in fact separate that subsurface right from the surface right. Residential real estate ownership is transferred fee simple. Property values are established by New York State residential licensed appraisers by comparing comparables, other sales that have taken place of similar properties within a short period of time and a short distance. Short period of time, 6 months to a year. Short distance, typically 1 mile to, could be 5 or 10 miles in some of the rural markets, but it is a contained area. So that they look for a 3-bedroom, bath and a half colonial to compare to another 3-bedroom, bath and a half colonial that is sold. And what has sold has set a value, so that they then compare the subject property and see, is one better condition than the other? Is one larger? Does one have, instead of 1.5 baths, it's got 2.5 baths? They can make some minor adjustments, but they try to compare apples to apples. The problem with fee simple ownership is, and gas leasing, is that it separates those subsurface rights, gives those to someone else, and that appraiser has nowheres to go to determine whether or not the property that he is comparing to the subject either has mineral rights or does not have mineral rights. That's not tracked independently by anyone in any county that I'm aware of in the state of New York. So there's our first issue. Make sense? The next we talk about is compulsory integration. And it adds another complex layer to the situation with gas leases. Compulsory integration, for those that aren't aware, is that if there is a drilling unit, 640 acres is what is considered common in the drilling unit. If 60% of that drilling unit has leases on it, the other 40% are forced to participate and allow subsurface operations. So you're actually forced to give away that subsurface right, if you will. Now, I say give away, there is a provision that you can participate in some profits. There are 3 specific guidelines that you have 30 days to decide on, and whether or not you participate by paying your proportionate share of the drilling cost and immediately get profit when profit is due, whether you allow the drilling costs to be taken out of the profit before you get paid, and there's some hybrids of that. But compulsory integration, so even if I decided not to sign a lease, and 60% of the neighbors that I had in this 640-acre drilling unit, if they, in fact, decided to sign a lease, I'm forced to participate, even though it would be something that I wouldn't want to do. It's a concern. I'm starting slow to build up to my crescendo here, so bear with me. Some of you have seen this before. Secondary market standards, I'm going back to stand in my spot here, and I'm trying really hard for these poor fellas. Secondary market, Fannie Mae, Freddie Mac, FHA, VA, Sonny Mae, State of New York Mortgage Agency, all have adopted specific guidelines. If you look at Fannie Mae and Freddie Mac, FHA and VA, they finance well in excess of 90%, something closer to 95, 96% of the homes in the United States through one form or another. Either the lender, the bank, Tompkins Trust in this case, or any bank or credit union, either originates the loan and sells to Fannie Mae, Freddie Mac, collects the payments over 30 years from that borrower, acts as their servicing agent, you're the bank's of primary contact, But the reason for the secondary market is to make a flow of usable, readily available, and competitively priced mortgage product available. In the days when I first started getting into the business, in the 70s, the bank would open their door on Monday morning and say, we got a lot of deposits last week, we can make mortgage loans this week. When that money was used up from deposits, we would close the door and say, there's no more funds available. We're not going to be able to offer any more residential mortgages until we get more deposits in. With the secondary market, it's created a liquidity. It's given the opportunity for that bank to originate the loan, sell it to Freddie Mac, a quasi-government agency, or Fannie Mae, or FHA, or VA, take that money and reinvest it in making more mortgage loans. So it's created a very liquid form of financing for banks all over the United States. In New York in the 70s, it wasn't appropriate. It wasn't going on to any great degree. But as we got into the 80s and 90s, it has really become the lifeline of banks to provide very low cost, very competitive financing. But there are some paybacks. The payback is that Fannie Mae, Freddie Mac, FHA, VA set their own rules. They set underwriting guidelines. They set property standards. And those are some of the things that we're going to talk about now for the next minute or two. If we look at Freddie Mac section 39.4, 39.4 states there's no subsurface, I got to turn around to read it, states, and there'll be no surface or subsurface entry within 200 feet of a residential structure. Now, we've got to go back to fee simple again. 200 feet doesn't mean 200 feet below the ground. It's 200 feet buffer, but to the core, to the center of the earth. There cannot be anything going horizontally through that fee simple ownership back at least 200 feet, measured on the surface, but to the core of the earth. So there's where you find a problem with compulsory integration that goes through that core, that fee simple ownership. That's where you find a problem with, meeting those guidelines. Anybody have any idea what New York State's regulations are today for the setback from a residential property? They do have 500 feet today, measured only on the surface. They talk nothing about the subsurface. Now, that is a direct result of me spending some time in Albany with a few other folks trying to bring about some knowledge to the folks in our government that made them aware of these regulations that they weren't aware of before. Previously, it was 100 feet. So that'll give you an idea. Now, when I do some studies from states around the United States, Oklahoma, Texas, etc., they specifically have setbacks 500, 600, 750 feet, 1,000 feet, and more, and they protect that fee simple ownership. If their title in that area is fee simple, they do something about protecting it. And that's one of the things that I think we need to be cautious of here. Okay? That's Freddie Mac. Fannie Mae does the same, by the way. Their guidelines the same. FHA and VA are who I'm going to talk about next. Let's talk about FHA section 4150.2D. And that is HUD minimum property standards that says, under a heading of operating and abandoned oil and gas wells pose potential hazards to housing, including fire, explosion, spray, and other pollution. Existing construction, this is right out of their property standards. No dwelling may be located closer than 300 feet from an active, and here's the challenge, or planned well. Note that this applies to the site boundaries, not to the actual well site. I don't know how we could ever determine where a planned well would be. We as homeowners would not know that, but that's certainly one of the challenges. FHA does have that on their standards. VA adopts the same. I'm pretty sure in your handout, and it might be in the back of the document, that I'm going to have some samples that I actually copied and pasted right out of the guidelines. I didn't change the words. I didn't do anything other than copy and paste, and gave you a slide that showed the exact sections of the guideline for both of these things. New York State mortgage document. That document creates the lien on the property, that pledge for collateral that the bank needs. And the bank is going to say, I'll loan you $100,000 to buy this house, but I need some collateral. And the collateral is the house, the property, the land. It's called a mortgage document, and that mortgage document has been in effect in New York State since 2001. It has not been revised since 2001. And there's a couple of sections of that document that I think are important that we look at and understand what they're saying. The first is section 18 of that document, and that says lenders may require immediate payment in full of all sums secured by the security instrument if all or any part of the property, and here's the key, or if any right in that property is sold or transferred without the lender's written consent. It states specifically in every mortgage document since 2001, this is used by a vast majority, 99% of the lenders in New York State use that same document. It's a standard in the industry. So if you have signed a lease after you got your mortgage, and your mortgage had this clause in it, which any from 2001 on have this exact clause, you've actually defaulted under the terms of your mortgage. It's a technical default. Now, I will be the first to admit that no bank is going to want to exercise on that default, foreclose, kick you out of the property because you did that. But I will tell you that it's not always the bank's full final say. If that loan was sold to Fannie Mae and Freddie Mac, we talked about how important it was for Fannie Mae and Freddie Mac to create liquidity. If that is now owned by Fannie Mae or Freddie Mac, they may very well make a decision to say, it's in default. Bank, you are on the ground, person in Ithaca, New York, or in wherever you are. Please enforce this clause. I don't think that's going to happen, but the potential certainly is there. Section 21 of that residential mortgage document, I've got to walk back over here again so I can give this poor guy a break, has another clause in it that I want to talk about for just a minute. And that is there are other substances that are considered hazardous for the purpose of this section. It continues, these substances are gasoline, kerosene, other flammable or toxic petroleum products, pesticides, herbicides, volatile solvents, and on and on and on and on. It actually lists it right out in the document. And then further states, and keep in mind, you as the homeowner are signing this document, so you are saying to the bank, I, the homeowner, will not cause or permit hazardous substances to be present on the property. I will not use or store hazardous substances on the property. I will not dispose of hazardous substances on the property or release any hazardous substances on the property. And get this, and I will not permit anyone else to do that either. So what you've done when you signed your mortgage is you said, there are things that exist, but I will not release them. I will not store them. I will not, do any of those things, nor will I allow anyone else to do it on this property. So again, if you've signed a lease after you've signed your mortgage document, you have actually technically defaulted under the terms of your mortgage. Again, a technical default. Again, I don't sense that any bank is going to run out and say, we're going to foreclose. But I will tell you that, again, if it's sold to an agency in the secondary market, they may very well take that control away from the local banks. It's important that you're aware of these things. Fair? Here is the full Section 21 document, copied right out of a mortgage. I put it word for word. I didn't change, copy, paste to give you a reference. Hazard insurance. It's important that every mortgage loan be covered with hazard or what's called fire and extended coverage that protects the bank. Again, the bank's loaning the majority of money typically for a house. There has to be hazard insurance on the property, fire insurance. In July of 2012, Nationwide, which is one of the top 3 homeowners insurance companies in the nation, issued a press release, and that press release said that they do not provide coverage for any loss associated with any gas leasing or drilling operations. Pretty severe penalty if you have your house insured with Nationwide and there is something that happens on the property that you've leased, you are not covered. There is no coverage. Nationwide also went on to say that they wouldn't, if they knew about it, would not renew the policies. Now, I will tell you that for about the last 3 years, I have been saying that the insurance companies don't provide coverage. No one believed me. I've called every insurance agent, company that I can think of, and I have yet to find an insurance company who said, yeah, we'll insure it. Most of them will dodge it. Most of them kept their heads low, didn't want to be in the limelight, but I will tell you that they have all stated that they have exclusions in their homeowners policies that exclude coverage for any commercial endeavor held on a residential property. Many of the companies have since come out and made more explicit comments that not only is it a problem with commercial endeavors, they just can't get their arms around what the liability is and therefore do not want to take the risk. So they will not insure or will not renew if they find out. Here's an article that came, and this is one of the newer slides, July of 2012, on the Nationwide. That's right out of the paper. I just copied and pasted it and put it in there so that you can see that that wasn't something I dreamed up. That's right in public information. Here is another article, and this is the one that just came out in February of 2013. And there's 3 areas in this that I'd like to point out to you because they are important areas that are things that you need to be aware of. Fracking-related damage, insurance industry insiders say is not covered under standard homeowners policies. Fracking is deemed an exclusion in the same way earthquakes or earth movement is, says Mike Berry, Vice President of Media Relations at the Insurance Information Institute, a nonprofit institute funded by the insurance industry. So right off the top, the insurance industry spokesman has said, it's not covered. It's not covered. That's the insurance industry expert. Let's go down here a little bit more. We would recommend that homeowners check their homeowners or farm insurance before signing leases, says Rosemary Placey, spokesman for the Pennsylvania Insurance Department. Again, I'm not making this stuff up, folks. This is right out of the articles. I'm not going to read the whole article to you. You can read that on your own. Last but not least, State Farm, another huge company that does a lot of insurance across the United States, set specific guidelines regarding hydrofracking. The company does not write commercial insurance for businesses conducting hydrofracking operations or for commercial properties where fracking is taking place. It does not have a fracking endorsement. It does not have a fracking endorsement for private residences. That's huge, because if you look at some of the leases, most of the leases that I see cross my desk that have been signed over the last 5, 6, 7 years, I don't see anything in there that provides for insurance coverage. We're now hearing from Nationwide, State Farm, the insurance commissioner, an industry expert from the Insurance Institute, all saying you're not covered. Who's covering this property? I think if you really look at your policies, you will find that there is no coverage. You're not covered. It's a concern. Last but not least, I've had some dialogue with Federal Housing Finance Agency, which is the regulator for Fannie Mae and Freddie Mac, to make them aware of some of those concerns. They have come and said, the guidelines are right there. Read them. So the 200-foot setback, fee simple ownership, the mortgage document that has section 18 and 21. They really haven't said, we're going to take off the table for certain instances. They've said the guidelines are very clear. We believe you as a lender should enforce them. Larry sent me an attornment certificate that a local bank had proposed to be used, a subordination, non-disturbance, and attornment agreement, and asked me what my opinion was. And this document basically says that the gas company would subordinate their rights in the property to the mortgage holder. And I said to Larry, it does something because it subordinates the rights, but it doesn't take care of the violation of section 18 or section 21 of a mortgage document. It doesn't take care of the fact that you have no insurance coverage. So I'm not sure that a subordination and attornment agreement answers all the questions that come up in my mind as we talk about gas fracking. Folks, that's the end of my prepared comments. I'll be here for questions. I know we've got another speaker, and we've got to do a quick change here of the plugs on this computer so that we can project the next one. Thanks very much.
As Greg said, we've got to take a second to make a changeover. If you'd really like to have something cold to drink, this would be a good time to get it. But it'll just take us a minute, and then our second speaker will come on.